Well, very nice to see you, Matthew. I'm Mark Jarvis, CEO of Giga Metals Corp. We have one of the three extremely large open pitable, low-grade sulphide nickel deposits in Canada that are undeveloped, and we are working on developing that. These projects, just in general, they're not high-grade underground projects. They're lower-grade open pit projects, much like, say, a copper porphyry project, similar in concept, very dissimilar in geology, by the way, but very similar in concept. And these projects are all undeveloped because they need higher nickel prices to be developed. Right now, we are seeing those higher nickel prices, and I believe it's just the beginning of a major move in nickel, driven by the electric vehicle revolution, and driven by the incredible demand, particularly for nickel, for the batteries for these electric vehicles.
Mark, good to see you. I think we saw you in London back in November. I trust you've had a great Christmas and holiday period. Look, appreciate you coming on. We've got this battery metals week where we're looking at some of the companies, some of the players in the different commodities under that theme of battery metals, and we're going to explain it in simple terms for people who are perhaps new to the space, new to mining, new to commodities. Maybe you have joined us from the world of tech and looking at the opportunities here. So look, we're going to might be worth kicking off the macro, right? So let's try and understand the thesis for nickel. We spoke a year and a half ago. We've spoken about your PEA, your preliminary economic assessment. And at the time, you said you probably need $8 nickel. And at the time, we didn't have $8 nickel. So what's changed and why?
Well, it's all about the electric vehicle. If you want range in your electric vehicle, you need more nickel in your cathode. Nickel has excellent energy density, and especially for the cost. And there's really no substitutes if you want range. There's another type of battery called LFP, which doesn't contain nickel. They're perfectly suitable for commuter cars, for cheap cars and stuff like that. But really, and particularly in North America, large engines, big trucks, that translates into big battery packs with lots of range. And for that, you have to have nickel. There really is no substitute. So, if you look at just simple supply and demand, and announced plans for gigafactories in North America, you need an incremental 250,000 tons per year of nickel just to feed North American gigafactories that are being planned to be built. And that's in a total market for nickel of about 3 million tons a year. So, of which most of the nickel currently goes to stainless steel. Another interesting factoid is that batteries as a percent of nickel use have grown from 3% of total nickel use in, say, 2017-18 to about 13% now. And it's just growing rapidly. It's, I think in terms of supply demand for nickel, this electric vehicle revolution is a once in 100 years phenomenon. And, it's just, how do you play it?
Well, how do you play it is the thing. So again, but this whole show, this whole series is for people new to this space and trying to understand the basics of it, right? So supply demand is always a great place to start. So on the demand, you're putting firmly at the door of the electric vehicle. Obviously, there are other drivers out there too, and yes, there'll be substitution of the different commodities. Nickel can be substituted out for some use cases, but the demand numbers are significant. So where's the supply coming from? Because you've talked about being low grade, open pitable, and we'll explain what that means in a second. But there's also high grade projects. Now, high grade sounds like they should be much better projects. So, what's the difference?
Well, for one thing, where are the new high grade projects? I haven't seen any for a while. Have you?
Nope.
And sometimes you get a high grade project, but it's not much tonnage, so it's an insignificant source of new supply. These this is what happened in copper. Copper used to be mined from high-grade underground veins. And then the whole copper porphyry model came along, And, at first it was met with disbelief, because how can you mine something that low grade? But most of the copper in the world now comes from low grade, open pit, copper porphyry mines. And the same thing's going to happen with nickel. And it's not just us. I mean, I think of the other deposits that are out there that are similar. I don't even think of it as competition. They all need to be developed and then some. And so, I strongly believe that all of these deposits are going to get developed this market cycle.
That's a big claim, right? Because that means there's a lot of money needs to come into the space to not just investing, but to actually finance the exploration, the development, and getting into production for all of the companies that are out there hunting it down. But let's stick with the high grade and low grade, because I want to make sure people totally understand before we go off elsewhere. You're right. There's not a lot of high grade projects out there, and those that exist just don't have the tonnage. That means there's not a lot of contained metal per cubic meter compared to, say, a lower grade, more homogeneous. The fact that the metal is spread evenly throughout that cubic meter. So, if I'm going to invest in a project, like your project requires a huge capex, right? So you're out with $1.5 million for phase one alone. You need to believe that you're going to get your money back, right? That's number one. Am I going to lose money? Am I going to make money? And that means there's got to be a lot of contained metal in a low grade bulk tonnage like that. It's got to be multi-decade, multi-cycle project. So, maybe talk a little bit about your project and perhaps why that should be or is attractive to investors.
Sure. Well, for one thing, we're talking about a project that will produce an average of 33,000 tons per year of nickel over a 37-year mine life. That's a giant project by anyone's definition. And, the competition is all of a similar size. The other competition we've got for development dollars is high pressure, high temperature acid leach projects. They're oxide nickel deposits, laterite deposits. They're strip mines. They're not open pit mines. And a lot of them are located in the Coral Triangle in the Pacific, in places like Indonesia and Papua New Guinea and so forth, in places that don't have very strict environmental regimes. They're quick to develop. But our project compares favorably in pure economic terms to those HPAL projects, which have a higher headline grade, but it's nickel and cobalt and clay. It's very difficult to get the metals out of the clay. It's very complicated and so forth. One of the strengths of our deposit is its simplicity. It's crush it, grind it, float it. It's simplicity itself. We make a beautiful high-grade concentrate, which we can then sell to a smelter, or we can then process via what's called POX, pressure oxidation circuits, into the precursor chemical forms of nickel and cobalt that the battery makers want. So now, where the Indonesian and Papua New Guinea projects outcompete us is that you can get a permit very quickly to build a mine there. Whereas in Canada, we have very high standards environmentally. It'll take 3 years to go through an environmental assessment and to get permits to build a large project. However, it can be done. It is done all the time in Canada. I guess the point I'm making here is that although you can build these ones in the South Pacific more quickly, you have to worry about the ethics of your sourcing of the battery materials. And so if you're buying an electric vehicle, for example, to try to save the world, you pay attention to where your batteries are coming from, because if they're coming from China and these HPAL projects, they involve strip mining, in many cases, swaths, mile after mile of tropical rainforest, processing very aggressively with sulfuric acid, and then dumping the tailings into the ocean. So with an incredibly high carbon footprint. We, by contrast, it's an open pit mine, so it's relatively small surface disturbance, relative to the amount of rock that we're moving. And we're very, very low carbon intensity. So if you care about the ethics of the supply chain of the electric vehicle that you're driving, you need to be looking at jurisdictions like Canada, Australia, Europe, rather than these HPAL projects in the Coral Triangle.
Right. So the Indonesian projects, high pressure acid leach, HPAL projects, sometimes referred to as a dirty nickel, would you believe? Okay. I think it's a nice marketing term to kind of create a them and us situation, but then you've kind of got the kind of Western approach and that's they are laterites. Your sulphides. And sulphides, that they do have a slightly more exacting environmental permitting process. Also, I think you touched upon perhaps carbon sequestration. So aiming for this net zero goals that the OEMs, the car manufacturers, are demanding of their supply chain. So it all looks good, but there's not a lot of you. There's not a lot of big projects. There haven't been big nickel projects for a while. And that's been partly because of being cash constrained and the price of nickel. But where do you see the market moving now? And we talked earlier about the need for more investment into, and getting all of these producers producing nickel, because we need it all. So is that possible? Is the money there?
I think the question you're really asking, Matthew, is how do little companies finance huge projects? Because, what's our market cap? It's 35 or 40 million Canadian. And we've got a project that we've modeled is spending 1.4 billion US on stage one, and then plus another $500 million to double capacity in year 4 or 5. It does lend itself to staging, to building in stages like that. Call it 2 billion US. How does a teensy little company like ours get it built? And we've talked about this before.
And retain enough of the value that you can create, exactly. Because the money will demand all of the upside, and you've got to retain it. There's the arbitrage that you've got to work at.
Exactly, and that is the classic problem of the mining business with large deposits that have been found by small companies. And that's it. So we have to get, and this is all of our efforts are currently being bent towards this. We have to get a strategic investor in at the project level. We think it'll take, from where we stand today, 30 million US or more to get to shovel-ready status. And I say or more because there's inflation happening in costs in the mining business right now, like nothing I've seen before. So all the numbers are moving around a bit. To do that by continuing to dilute our equity would leave nothing left for the shareholders. And I'm the largest shareholder of our company, and so that's not what I want. I'm not in this for a salary. I take a very modest salary. What we're doing right now is we're focusing on the people that actually need the nickel and are going to need the nickel over the next few decades, particularly battery companies. Western battery companies. The Chinese battery companies already have their supply chains figured out, and the Western battery companies don't. So if they're going to be around in 10 years, they better get their supply chains figured out, and they realize that. So there's a lot of discussions going on, and we want to get them involved at the project level, put in 30 million US to get X% of the project. And then we are free to advance the project without equity dilution at that point, to shovel-ready status. Also, if we get terms that we're trying to get, it's going to imply a much higher valuation to our market cap than we currently don't enjoy. So, that's really the solution. And I'm very hopeful at this point. These things don't happen overnight. We're talking to extremely large companies with extremely large bureaucracies where you have to find an internal champion and they have to push it up the chain of command until you get to a decision maker. But we're doing that. We're doing that in several cases. And, That's going to be the key. That's the key development to watch for with us going forward.
Right, but you're. I mean, talking about you, that is exactly where I wanted to go with it. With the question, by the way, is because investors looking into this space, might be looking at companies like yourself, sub 50 million, say, and go, well, how do they do that without diluting the heck out of existing shareholders? How do they get to that end point where there can be some exit event or some monetization event or some sort of strategic investor or whatever that moment looks like? And it's difficult. It's really difficult. It's a lot easier though when the price of the commodity is as high as it's been. Well, I think in nickel's case, ever. These prices are extraordinary. At the moment.
These are the highest prices since about 2011.
Right. What happened then?
Well, that was a dead cat bounce after the 2008, financial meltdown. And then Indonesia stopped exporting raw material. And so that caused a run in the nickel price in 2011. And then Indonesia relaxed that and the nickel price went down again. Now, the whole rise of electric vehicles is a brand new source of demand. Again, a once in 100-year event. I mean, this is, I haven't seen anything like this in my career. This whole new source of demand, and it requires pure nickel. There's a lot of, more than half of world production is what's called ferronickel, which is a mixture of iron and nickel and all sorts of other impurities. Perfect for the stainless business, but not perfect for batteries. And you can take any form of nickel and process it and purify it, but it's a question of economics. How much does it cost? What we've got lends itself to direct development to the cathode supply chain.
Okay, well, let's come back to using you as a case study. Okay, so you are where you are today. You've talked about leading 30 or more million bucks to be shovel ready. So shovel, just again, make sure everyone understands the terminology. Shovel ready means what? Shovel ready
means you've got your engineering completely done. You know exactly what the mine looks like and how it's going to be built. You've figured out the construction schedule, and you've completed your environmental assessment and have construction permits. That's shovel ready.
Okay, so and to do that, you're talking about a minimum of 30 million bucks. Yes, there is inflation at the moment. Costs are rising steadily, and supply chains are being affected. Costs are being dramatically affected across the board. It will require you to deliver a bunch of studies. So we'll go through. You've got a PEA. Are we moving on to a PFS, feasibility study, and definitive feasibility study, or will you be skipping?
Yes,
you will. You go through the standard phases. No surprises there, and each one of those delivers a different level of certainty. So PEA, what it could be. You've a PEA, what it could be. PFS, what it should be, and a feasibility study, what it will be effectively, and the DFS just firms up on that. Is that fair enough?
That's a very good explanation. It's each level of engineering study is simply a higher level of detail on every front. Okay, so and just a higher level of certainty on every front. There's a saying in the mining business: you don't really know what the mine looks like until you built it and operated it. But it's you do know quite a bit, particularly with deposits like ours, which are relatively homogeneous. You see, it's different than a high-grade underground deposit where you've got super high grade and a nice little chunk here, and then you've got low grade and it's a skinnier bit there. And how do you mine this? And it's very difficult to predict. And in fact, in the old days with vein deposits for gold mines, they'd maybe find a bit of gold, and then they'd just start mining it because with those types of deposits, drilling it to 43101 standards, you might as well start mining it with the money you're spending. So that's what they did in the old days. And some of the most famous mines from the sort of early 1900s, they found a bit of gold at surface. They started tunneling in and mining it and stoping it out, and they ended up with 3 million ounces. They ended up with 1 million ounce stopes. And then sometimes it would peter out and turn to nothing, and they'd stop. So it's it's inherently less predictable, whereas a large homogeneous ore body is more predictable and less risky. You know what you've got. You've got a very high degree of certainty about what you've got. And in fact, in our case, a lot of the uncertainty is about your resource. You've got inferred resources. You've got indicated resources. You've got measured resources. And what it really amounts to is a denser drilling pattern. And and what we found with our deposit, and we've drilled over 400 holes in this thing, is that if we've got inferred resources and we do infill drilling, that the hole that's in between the two holes is, dare I say it, always very similar to the holes around it. That's been the case historically. That doesn't mean it's always going to be the case, but you kind of start to expect it after a while.
Right. So homogeneous is good. It means technically it's simpler. The expectations are similar, and it's an earth-moving exercise because it's fairly, I say, homogeneous, and therefore the process of extracting the metal is fairly similar. There's no shocks or unwanted kind of situations, right? So okay, so that's where. So again, so let's stick with you as the kind of case study for this. So we've talked about the money and the need for a partner, and you're going through a process at the moment. We talked about the simplicity of the low grade sulphide, bulk mining. I think is could be referred to. With regards to going through those steps, we're in terms of the studies and so forth, we're seeing acquisitions being made at different phases. It's not a case of you have to deliver all of those phases and then say, right now, who wants to buy us, who wants to invest in us? Because you've seen projects like Noront, you have Wyloo and BHP fighting over that. Compared to you, where are they? North, south, east, west?
Their engineering is more advanced than ours. I think they're at feasibility level. And it's a higher grade deposit, but you need to spend more than $1 billion to build a road in there. And they're planning to dig a hole underground. It's in the middle of a swamp. And anyways, I mean, that's a different
but I think my point is, and if you look at people like Canada Nickel, who are perhaps, going through, ahead of you in sense of they're kind of, I think they're kind of going through the study process at the moment, but you're all similar in the sense that it's low grade bulk tonnage. And the point is that you're in demand. Right, people are seeing this as long life of mine. You're 30 years plus, and I think both Noront and Canada Nickel would like to say that there's something similar. But you're in demand. It's not off-putting for BHP or a Wyloo to have to spend $1 billion putting a road in because there's enough contained metal.
Well, especially it's all a question of pricing and it's all a question of risk. I would say that of the large undeveloped projects of the world, ours is the simplest by a country mile. I mean, it is without getting too technical, 99% of the nickel and cobalt are contained in pentlandite, one mineral. And so crush it, grind it, and then the froth flotation has to do one thing and one thing only: float pentlandite and suppress everything else. That's it. It's so simple. And it's 100-year-old technology. Everybody knows it works. If you're going to spend a couple of $1 billion building a mine, you need to be happy that it's going to work. And that's one of the things that differentiates all the sulphide deposits from HPAL. And it's the thing that I think differentiates us from all the other sulphide deposits. They're more complex than we are.
Okay, so there's a need for all of the above. You've said that at the beginning. You've got a simpler process. Noront have got a higher grade. Canada Nickel have got a lot of prospectivity. You've each kind of got something. But the point is, on the supply side, people are looking for projects like yours. Investors should look at low-grade bulk tonnage nickel projects just as readily as they might, or just as eagerly as they might look at some of these high-grade numbers, which some press releases, they're very attractive. People get attracted by high-grade numbers, but you're explaining today to investors why you're not a bad bet.
Let me say this, is that history tells us that when a small company has a huge project, the investors do best when the whole company gets sold at some point. I mean, we all know that. We all sort of pretend, oh, we're going to build this, but it never happens with small companies building large projects. That's what history tells us. And if you try, you just blow yourselves up, and the shareholders suffer. But if you sell the whole company, then the shareholders do very well indeed. And ultimately, market permitting, the mine gets built, and now you've got a new mine. Our approach is not to be talking to the mining companies right now. It's premature. Our approach is to get that strategic investor on board at this stage for, say, 20% of the project, and get a re-rating in our stock. That will deliver that. I feel confident. And then be able to develop it a little further, let the nickel market develop a little further, and ultimately sell it for the highest possible price we can get.
Right. So we've explained it simply for people new to mining and new to investing in mining companies, let alone nickel mining companies. Let's give a little bit of something for your current shareholders in terms of your approach. As you've just described, 20% for, let's say, $30 million company, you're expecting some of the 30 plus million, and you're going to be doing this in stages. Otherwise, you're going to blow your share registry up, asking for 30 million up all at once now, right?
That's right.
Okay.
That's right. My financing method of last resort is equity financing, because we think that our stock is far too cheap, and that we're giving away the project far too cheap every time we do an equity raise. That said, you have to keep advancing the project. I think you strategically have to keep advancing the project, particularly in the nickel price environment that we're in now. So choice one is to get a strategic on board at the project level rather than at the equity level.
Okay. Look, Mark, I think given that this conversation is really for sort of slightly a newer audience, I think we'll leave it there. Perhaps we can talk again and dive into your project proper for, your shareholder, perhaps a little bit more experienced audience. They might do that in the context of some of the other battery metal stories, and maybe in specific some of the nickel stories out there. Because as you say, and as we say on our weekly battery show, we need all the nickel projects we can get. It's not a competition. We need all of the above. We're walking into huge deficits across the board. So appreciate your time today. Thank you.
Thank you very much, Matthew. I appreciate your time as well.